UK stocks tumble as China's buying frenzy wears off. Welcome to Market Insight, I'm Peter Devlin. The UK's main stock indexes fell on Tuesday as China's pledge to support the economy disappointed investors, hoping for a new stimulus. China-exposed stocks including miners, luxury brands and financials saw heavy selling pressure. Meanwhile, home builder Vistry dropped after it cut its annual profit outlook, dragging the household goods and home construction sector to a 3-month low. So where are the signs of optimism for UK markets? Well, to help answer that and more, I'm joined by Fiona Cincotta, market analyst at City Index. Welcome, Fiona. Thank you very much for joining us. So the tone in European markets has improved throughout the day, but the FTSE 100 is still languishing fairly close to the lows of the day, down by more than 1%. So is the UK more exposed to China sentiment?
Yes, that's exactly it. There is more exposure in the FTSE 100. If we think about what are the heavyweight stocks in the FTSE 100, they're the miners, they're also the banking sector. And that's what we're seeing really impacted here by the disappointment in China. So miners are under pressure because the industrial metal prices are lower. Also resource stocks more broadly, because we've seen oil come off as well. China is the world's largest importer of oil, so it's impacting natural resources across the board. And then also within the banks, you've got those banks such as HSBC, that's down around 3.5% today, which also has high exposure towards the eastern side. So, I mean, that's why we're seeing that the FTSE has fallen harder than its European peers, and it's not really showing any signs of picking up off of those lows either.
Some data as well from the UK, Fiona. Consumer spending rose at the fastest pace in 6 months. That was according to a BRC survey overnight. So will UK retailers benefit as we head into the holiday season?
Well, we'd hope so. I mean, actually, to be fair, retailers have been performing pretty well so far this year. I mean, if we look at the likes of Next or Marks and Spencer's, they have outperformed the FTSE. They're up around, Next up around 22% year to date, and the Marks and Spencer's up around 33% year to date. So strong performance there. On those expectations that as interest rates start to fall, as inflation is cooled towards that Bank of England's 2% target, that does mean that it's a more favourable position for households and particularly for discretionary spending. So on the back of that, that's why we've seen sort of the retailers performing well. They're up around 0.5% higher today, Next, for example. But as far as sort of the outlook is concerned, I do think that the outlook does remain dependent on the UK jobs market remaining resilient, and also on the budget not being too dramatic or too harsh on households.
So Fiona, let's take a closer look at luxury stocks now, and they've been on a roller coaster in recent weeks, whipsawed by the mood swings around stimulus measures in China. So looking at Burberry, can it turn it around as we approach the earnings season?
Oh, that's a good question, because Burberry has been hit particularly hard. I mean, the share price is down around 50% year to date. It's very much struggling. Not only I think there are questions over its brand, but also, as far as you mentioned, the outlook for consumers in China. We know that there has been a lot of weakness as far as consumption is concerned in China. And the big question is, will this stimulus package that has been announced, but which for the details have been really quite few and far between, be sufficient to be able to turn consumer spending around in China? And I think for what we know right now, that probably isn't the case. I think we do need to have more details on how Beijing and Chinese authorities intend to keep growth, or in order how Chinese authorities intend to boost growth in order to know that the consumer spending will return strongly in China. So I think it's still too early to be able to say that the likes of Burberry will be rebounding strongly. I think that's quite a story that we'll see play out probably more in 2025 if it's going to happen.
So finally, the top loser on the FTSE today, home builder Vistry, it did wipe out a third of its value after warning of higher costs. Does this overall spell trouble for the UK construction sector?
No, I don't think it does. I think this was quite particular in the sense that it was related to do with a shift in its strategy away from traditional house building towards its partnerships business, where it's sort of teaming up with local authorities to provide housing. And so I think of those 300, basically of 300 sites, 9 of them have been poorly costed. And that's actually to an extent of 10%, which sounds like a small amount, but actually it can turn into quite large numbers. And that's really hit the share price hard. So I don't think this is something that we're expecting to see sort of impact other house builders across the sector. In fact, I'd say quite the opposite. I think actually the outlook for house builders could be starting to improve as we see those interest rates come down, or expectations for interest rates to come down. That means the mortgage market should become more competitive, should be easier for people to get mortgages, and therefore that is positive as far as house builders are concerned.
Fiona Cincotta of City Index, many thanks for your thoughts. And that's Market Insights. Don't forget you can watch more videos on Reuters.com.